Welcome all to the Node, your place for news, interviews, and education. I am Mike, aka Veteran Crypto, and David will be joining us here in a moment. But while we wait for him, let's go ahead and dive into the introducing the socials. So today we're going to be talking about the potential for BTC on Base, other than Coinbase wrapped Bitcoin. There's been some rumors of that. So we're going to actually dive into the technicals and find out if that's even a possibility today. How's it going, David?
Good morning. Good afternoon.
Yes. There we go. Let's add you to both. All right. So let me go ahead and share the socials real quick, and then we'll get on into this. All right. So if you want to join the conversation, go ahead and find us on YouTube. And the way that you can find us is at the Node Network, all one word. If you'd like to find us on X, you can find us at the Node_network. This is where you can find all the different news and articles that that I find throughout the day and share with the community. And then if you want to find basically everything that we offer, you can find it at the node.pro. This is our official website, and it truly is the node of the node. It's where you can find a lot of our no-cost materials, our no-cost offerings, like DeFi University, which is a start to finish, entry level to advanced educational system where you can go through and there is structured content. There's videos, there's slide presentations, there's material that you can read, there's tests, checks on learning, all of it, and we give it all away. We don't charge for any of it. So it is a great resource. A lot of other people out there will charge hundreds, if not thousands or tens of thousands of dollars for access to things like this. So, make sure that you take advantage of it. Morning, Mr. Zimmy, and Memorial Day to you too as well. I hate saying Happy Memorial Day because those that understand what Memorial Day is all about, it's not necessarily a happy thing; it's a solemn thing. The newsletter. So this, and correct me if I'm wrong, David, but I believe this is ready for launch.
I think it's ready to rock and roll, Mike. I sent you, a copy of it, the pre-morning brief earlier today, and I think it's ready to rock and roll, man.
All right, yeah, I'm going to go over that here in a minute. I'm going to bring up the email, and we'll go through, kind of show what it looks like when it shows up in your inbox. But that is only 66 cents a day, $20 a month, and it is a custom AI newsletter that generates for the assets that you select. And I'm talking, commodities, stocks, crypto, all of it. So this is a very, very unique newsletter because it creates it for your portfolio, not for the portfolio that I build or David builds or, anything like that. So it gives you links. The important thing is it gives you links to everything to verify. So if you ever feel like that maybe it's not accurate, you can, it cites its sources. You can go to the source, you can see, you can check, make sure that it's accurate. So it's definitely something I have not seen out there yet. And again, only $20 a month.
So Mike, before you move on from the newsletter, just real quick, I want people to know, exactly what it is that they're going to get. And so there are actually 9 sections in the newsletter. So when you select the assets that you want in your newsletter, you can select up to 20. And after you select them, then that newsletter is going to be generated for you for those assets on your watch list and sent to your email address twice a day. Once before the market opens at 9:15 a.m. Eastern, and once after the market closes at 4:15 p.m. Eastern. And so there are 9 sections in that newsletter. The first one is a snapshot, just prices of the assets that you want to track. The second section is ranges, where you'll be able to see all of the ranges for those assets that you're tracking. The third section is the on-chain data. Have there been a big whale movements on chain? The fourth section there is the flows. We're talking about inflows, outflows into ETF products or exchanges. The fifth section here is derivatives. So, do you see like big futures movements? What's open interest looking like? What are funding rates looking like? And then,
Liquidation.
yeah, exactly. Liquidations, exactly. And then section 6 is catalysts for like the week ahead. What's going on with your assets, over the next 7 days.
Is the Fed gonna do an announcement, or something like what's on the docket? What's on the schedule?
Exactly right. Is there anything that could be market moving for the assets on your watch list over the next 7 days? The seventh section here is the big story. So, what was the overarching big story that got all the buzz today before the market opened and after the market closed? Section 8.
You missed the quick hits.
Yeah, so I've got that as section 8.
Oh, okay.
So they might be, flip flop there, but section 8 or section 7, depending on where you're looking at it, is the quick hits. And so that's just like, 3 quick articles. If you just want to scroll through and read 3 things for your watch list, that's the quick hits section. And then the last one, the ninth section, is the node take. So, what does the node see? It's basically a synthesis of everything in your watch list, all boiled down into like one paragraph with like a couple of quick takeaways. So if you just want to stay up on your P's and Q's and figure out what's going on with the market every day before it opens and after it closes, this is the way to do it. And you see Mike is scrolling through it really fast here, but there's a lot of data in here. And depending
I don't
on
want to give it. I'm not going to give it away for free. We give away enough stuff for free. I don't want to give away the newsletter. It's like one of the only things that we charge for.
Yeah, no, for sure. But just check it out, while it's still available like this on the website. Definitely very valuable.
Absolutely. And then coaching. So this is one thing that we do charge for. This is a one-on-one intensive, fast tracking. So if you have done your basic, education, you've gone through DeFi University, or even if you haven't, and you just want to fast track, you want to get to where you understand DeFi and crypto, and how to deploy liquidity into the markets, things like that. This is a live one-on-one, and you can do an exploratory call at no charge, and sit down with David and discuss. And if you do this, it's 6 to 8 weeks where he goes through multiple live calls with you and gets you up to speed on how to use DeFi protocols, how to figure out which ones are safe to deploy your liquidity, how to use the different wallets, bridges, things like that to navigate safely, and best practices so that you don't get hacked, you don't get your liquidity drained out of your wallet for clicking on the wrong thing or going to the wrong place and connecting your wallet, things like that. So this is another service that that we provide. And then our community. So we have a couple of paid communities. So you can we have our premium YouTube, we have our premium Discord, a channel in our Discord, and the DeFi University School that you can do on 3 days a week. David does live calls with a bunch of people that he's mentored, and they've all since they're at different levels, but different levels of success in DeFi investing and just in investing in general. And so what he does is they're open, open roundtables where he usually has a lesson, but other than that, it is open forum to where people from the community can, talk about maybe opportunities that they found, advanced DeFi strategies or opportunities that they found, doing, looping and things like that. And also, maybe things that they found that don't work, that they tried something, it didn't work. So not just opportunities, but pitfalls to avoid, which is ultimately why you would want to find a mentor. Is to find somebody that's more knowledgeable and more skilled than you that can help you avoid the mistakes. Because I mean, eventually you're going to get to a point to where you're going to be able to make profits. The trick is to be right more than you're wrong. And if somebody can help you avoid the bad choices or just even the stupid mistakes like I've done, trying to bridge assets, trying to send assets, and sending it to the wrong address. Just beginner mistakes. Hell, there was that one person that lost tens of millions of dollars just from clicking through too fast. Not too long ago, about a month or two ago, they lost tens of millions of dollars due to slippage. Just because instead of reading the pop-ups, best practices, always read the pop-ups. They just clicked through and lost the majority of their money. So, these are the things, why you need a mentor, why you need a community is, to keep you, grounded, to keep you.
So Mike, I think it comes down to like market tuition. Like you don't want to pay market tuition.
If you don't have to. Yeah.
You really you need a mentor to be able to show you what to avoid. And so in those communities, let me give you just a quick example of something that someone posted in the school just a couple of days ago. So there's a protocol out there called MaxFi. Okay, it was built by one of the guys over at Crypto Labs. And, so one of my members was posting about MaxFi, asking questions about it. And I went ahead and took a look at it. And you see, people don't understand what impermanent loss actually is. They don't understand the Greeks. They don't understand, what concentrated liquidity provision positions actually are. And so when I saw this protocol called MaxFi, what it is an agent that allocates to liquidity pools. And you see, here's the problem. The guys who built that tool, they know, or at least they should know, that that tool doesn't actually make money in against impermanent loss. Like your baseline is, if you had just held those tokens and done nothing, then did you outperform or underperform? When you provide concentrated liquidity, almost always, especially in stablecoin pairs, your gamma is going to be greater than your theta. And so that means you're structurally unprofitable, statistically unprofitable when you enter. And they should know this, okay? I know this, they should know this. And, so I had a member posting about it, asking me questions, and it's so misleading because when you take a look at the MaxFi website, what they show is like fees generated. And of course, the fees, it's always going to be positive. You're generating fees, but what you put up in the pool, if that is losing more value than the fees that you're generating, then you're not actually making any money. And so like the way that they have this tool set up, it doesn't show anywhere your impermanent loss or your P&L versus holding.
It's just showing fees. People just
all it does is show fees. And so people just assume like, oh, this is a money printer. It does 10% per month. It does not do 10% per month. It is not real. And the thing that really irks me is that those guys know that. They know that that's not real. That's why they don't show the IL, because if they did, then no one would ever deposit into it. And so, look, the value of having a mentor like me or a group of people to talk to in school, in Discord, the value of that is when you've got a question about a new protocol that you see, you can ask it of me or a bunch of other people who have years and years of experience, operating in DeFi.
Many of which make their living off of investing. I know that you do. Your entire, your entire living is made out of DeFi and TradFi and investing and things like that. So it's not just something that you preach; it's something you practice.
Yeah, and the live calls in the Discord, in the school, and you can also join through YouTube. Those live calls are 3 times a week. So Mondays, Wednesdays, and Fridays, you've basically got like an open office hours forum where you can ask questions of me live. So I think it's valuable.
All right, and last but not least, these are our network of shows. So we have multiple shows. You can see the Node Daily Show is this show, and it's Monday through Friday, 9 a.m. Pacific, noon Eastern. Immediately after this show, on Mondays, Wednesdays, and Thursdays, you have the blockchain report with Jeff, our third co-founder, and he does deep dives into early projects. He's great at finding these early projects. And then we have the daily market wrap. So David, at 4 p.m. Eastern, when markets close, he actually does about 20 to 30 minutes of technical analysis, goes over what happens in the markets, what happened in the markets that day. And on Tuesdays and Thursdays, he does live coaching. So the coaching that we offer, he took a member of our community and is teaching her live. So showing, what he does, in those, that one-on-one coaching program. So, we want to be very transparent about, what people will get. Monday, Wednesday, and Friday is the live calls that we were just talking about, with the community. And then we have Crypto and Chill on Tuesdays and Fridays, and that's myself and Jeff just talking about what has happened in crypto on a more macro level, in between each of those shows. And then we have the Red Pill on Thursday evenings, and that's pretty much just where us and we have different guests that come on, and we just drink, and people smoke it if they got it, and just talk about controversial topics. And it's just really just a hangout and a place to vent about whatever's going on in the world at the time. And then I do Sovereign Soil on Saturdays, and that's about emergency prep and homesteading, if you're interested in that. And we're going, and then we have Saturday Night Fever, which Jeff is a DJ in the San Francisco Bay Area. And actually this weekend, he went to a couple of different events and did a bunch of more interviews. So he's always doing interviews with DJs and things. It's actually quite the show, if you want to check that out on Saturday evenings. And then we're tossing around the idea here in the near future of starting a workout channel and a healthy eating channel. So in our community, there's a bunch of us that like to eat clean, or clean-ish. Jeff is the extreme.
What is clean-ish?
well, Jeff is the extreme. He is like 100% clean. He drinks, goat's milk and all that kind of stuff, and doesn't eat anything that's refined or processed. And me myself, I like to eat, probably like 80-90% of what I eat is locally sourced, healthy stuff. I drink well water. I don't drink bottled water, things like that. But I like, occasionally I like to have a bowl of ice cream, or I like to have a snack or something like that. And not every day, but once a week, every other week. I'll have a piece of pie or something like that. So that's ish. I'm the ish. But working out, is a huge part of my life. Just the older I get, I find that working out keeps me active, keeps me sharp, and makes it to where I can function better on my homestead. Because I'm a homesteader, and I live alone, so I like to be able to move stuff around and get work done, without having to rely on other people. So fitness is a big thing for me. So anyway. All right, let's get into this. So, right out the gate, I wanted to touch on this because I was seeing rumors about the potential, and David's going to do a deep dive on this in the second half of the show, but I wanted to touch on it. I keep seeing these rumors about, native BTC on different layer ones, and in this case, a layer two on ETH, which is base network. And so I wanted to get to the bottom of this and understand the technicals of, is this even a possibility? Can you have native Bitcoin on other layer ones and layer twos? So it says Coinbase wallet recently, and I did this morning. I logged into my Coinbase wallet, and it actually prompted me to enable this. And that's what got me going on this. So it recently updated its base mode. The default interface optimized for low-fee layer 2 transactions. Originally, if you wanted to interact with Bitcoin, you had to use the legacy multi-chain mode. By hitting Enable Now, which I did this morning, for Bitcoin in the base interface, you are giving the wallet permission to pull your Bitcoin balance into your main scannable portfolio layout, allowing you to bridge, send, or use your Bitcoin position directly inside the base ecosystem. So the macro backdrop, the war for wrapped Bitcoin. The reason Coinbase, and those that don't understand, and again, I'm sure David will get into this, but if it's not native Bitcoin on Bitcoin mainnet, then it is a wrapped or synthetic version. Coinbase wrapped Bitcoin, WBTC, wrapped Bitcoin, everything else out there is just a Bitcoin, a version of Bitcoin that should be backed by Bitcoin. Coinbase wrapped Bitcoin is very popular because Coinbase, the custodian of the native Bitcoin, that backs Coinbase wrapped Bitcoin is it's traded on the New York Stock Exchange. It's trusted. Institutions trust it. Coinbase is the custodian for many ETFs, the Bitcoin that are held in these ETFs that we all hear about. So it's one of the more trusted. But so back in 2024 is when Coinbase launched that. It is backed 1-to-1 by physical Bitcoin. I don't know if I call it physical, but it's backed 1-to-1 with actual Bitcoin held securely in Coinbase Prime custody. It became an instant hit on Base, absorbing billions in liquidity because DeFi users trusted Coinbase's institutional grade custody over older alternatives like BitGo's wrapped BTC. The new threat, Circle's BTC. The massive success of Coinbase wrapped Bitcoin just triggered a direct counter move. Circle, the issuer of USDC, just announced Circle BTC, their own institutional wrapped Bitcoin. Unlike Coinbase wrapped Bitcoin, it relies on off-chain custody attestations. Circle is promising real-time, on-chain, verifiable proofs of reserves. That's very interesting. Coinbase wants to lock down its home turf. Over 60% of the collateral driving Base's largest lending markets like Morpho is powered by Coinbase wrapped Bitcoin. By making it seamless for retail users to turn on BTC inside the wallet, Coinbase is streamlining the pipeline to onboard native Bitcoin holders straight into Base's DeFi infrastructure. I'll be honest, I don't understand that. And that's why I'm excited to hear the deep dive that David's going to go into. Again, we're always transparent here. If I don't know something, I'm going to let you know because I don't want
to. So, Mike, I've got all the research ready to rock and roll too, man. It's pretty interesting stuff, especially for maybe some viewers who might be a little bit newer to the Bitcoin derivative space, the wrapped Bitcoin token space, the ecosystem of all of these different Bitcoin derivatives. So yeah, got some interesting stuff to share later on in the show.
No, I'm excited to hear it. All right. So a little bit of Canton news. So Yuval Ruz is the CEO of Digital Assets, who is the one that created the Canton Network. And he's saying that crypto is finally repricing empty shell models. So he said the latest crypto sell-off is repricing empty shell token models and pushing institutions into chains with value, privacy, and predictability. I tend to agree. The cryptocurrency market sell-off is forcing a reckoning in the industry to reward blockchains with real business models, where value flows to token holders and users rather than intermediaries or speculative order flow. Ruz is the founder and CEO of Digital Assets and the institutional-grade privacy-enabled Canton Network. In an exclusive interview, he told Cointelegraph that he's not worried about the state of the crypto market, and the turbulence hasn't scared off his core customer base. He pointed to Canton Network and derivatives exchange Hyperliquid as examples of what innovators are gravitating towards. And the price and volumes are reflecting this. Hyperliquid's pumping. The past day or two, we've seen Canton, getting some positive flows. We're seeing, Tron. We're seeing, other solid assets that have good, solid tokenomics with steady growth. Whereas we're seeing a lot of tokens with poor tokenomics taking dumps. And to be honest, there are some with really poor tokenomics that are seeing some positive price. We've covered Ondo, for example. So Canton's network cryptocurrency rose 25% in the past month, while Hyperliquid surged 28%. While people start to understand, what people start to understand is that all of crypto narratives have been empty shells. He's talking about the hype. There's no shortage of it. You go on social media and you're going to see these endless posts of people trying to paint like this, massively bullish picture for these ridiculous valuations. Many of these projects already have ridiculous valuations, multi-billion-dollar valuations, and the underlying protocol or chain or company make no money. There's no revenue generated, no fees generated, and they have their market cap is in the tens of billions of dollars or even billions of dollars. It's ridiculous. It's vaporware. It's exactly what he's talking about here with this empty shell model. That's what he's getting at. And this is something we've been saying here on this channel for months, if not years. There is going to be a culling. These vaporware projects that offer nothing, that do nothing, that have just been hyped on social media to retail and gotten people and I fell victim to it. Not victim, I'm a grown man, but I saw a social media post about a meme coin. And I thought to myself, you know what? I'm gonna jump in. It's I've been wanting to get into crypto. I'll give it a shot. And luckily, I made some money. But many people have a very different experience. Many people get involved in these projects. They get rug pulled. They are told that it's going to go to some ridiculous valuation, and they hear that confirmation bias, and they constantly hear that their project's going to go to the moon. And they keep dumping money into it until one day, a lot of these projects, the founders and VCs hold the majority of the tokens, and when they feel like they've pumped it enough, they dump, and they suck all the liquidity out of the project and leave retail holding the bag. It's happened time and time again. So, anyway, I'll get off my soapbox. All right, so this is the email that David was talking about.
Sweet. This is cool stuff here.
So you want to walk us through it, David?
Yeah.
I'll scroll. Walk us through it.
Yeah. Let's take a look at this. So, that first section right there that you're seeing in the newsletter.
This is the newsletter that we offer for $20 a month. So we're going to give you today for free. We're going to give you the newsletter. So this is what David sent me this morning. Go ahead.
Yeah. So I don't know, Mike, can you zoom into that at all? So that we can see it a little bit. It doesn't quite look right. I bet that's about as good as it's going to be. Okay, that's fine. Yeah. So that first section there, that's the snapshot. Okay, so it's just giving you a little bit of a market snapshot. And
if you want me to read something, let me know.
Yeah, I just want to scroll through the sections just real quick. So after you get through that market snapshot, it's going to give you a brief overview of what's going on in the other sections. Then when you scroll down, you're going to see the trading ranges here. So you got your market snapshot right there. So those are all the ticker symbols that I threw onto my watch list there. And these are data. I think that these data are actually not correct. Fuck.
No, they're not.
Dude, this fucking newsletter, man.
I know.
This
all
thing.
right. We're gonna move on. It's that's a no-go for me if it's not given accurate data.
No, it's not pulling the right things. Okay, well, I'm gonna have to pop back in there and fix that. Shit.
All right. Well, let's jump into the news. So don't go get the newsletter. Just use the free version, the no cost version. It's not as comprehensive, but yeah, definitely don't go get it.
Let me take a note on that.
All right. So the tokenization pipeline. On the institutional plumbing front, Wall Street is continuing its aggressive expansion past simple proof of concepts. So significant momentum is building around tokenized real world assets, or what's known as RWAs. Specifically tokenized treasuries, with major entities shifting standard repo or repurchase agreements, trading over to enterprise grade rails like Canton Network. So Canton Network, this is where that massive amount of liquidity that they got right out the gate. They were able to secure $400 billion in liquidity. And that's what caught my notice is I go to this website every morning to see what's going on with
yeah,
RWA.
you see what Keith Cameo put in the chat there, Mike. Near, Zach, Hype, VVV. Yeah,
Yep.
those are the ones that are most hyped right now.
Yep.
And those four right there, they've been pumping, man.
I have a small bag of VVV that I've had staked for about a year or so now, since they launched. It very, very small. Hype, I'm very bullish on. Zcash, I understand why that has been popular. Near, I'm excited to hear what you have to say about Near. I don't know if that was today or tomorrow, but
yeah, I've got that one ready for today.
Yeah, I don't know about Near, but I'm keeping an open mind. I held some for a while and got out of it, but we'll see. So this is where I come every morning just to see how the ecosystem, the RWA as a use case is growing or shrinking, and you can see over time it's just up and to the right. But one day I popped on, and all of a sudden there was this new project called Canton, and had never heard of it before. And at the time, it had like $400 billion in liquidity, and so it made me start to look, deeper into it. And actually, I ended up reaching out to one of the co-founders, Shal Kafur, and I was very surprised that he was willing to come on the show. He's actually been on twice now, and to talk to us about this project and educated me on it. And since I have built a bag of it, and I'm glad I did. But this is somewhere that I go every morning. But back to the news. Let's see.
So about Canton, just real quick, Mike, before we move on from Canton. One thing that we talk about on this channel, on our show every single day, is we ask ourselves this question: is there a connection between the revenues that are generated by the protocol? Think of it as a business. Number one, does it generate revenue? And number two, is there some mechanism by which those revenues are returned to token holders? And if you judge your protocols by that metric, does the underlying protocol make money and does it return those revenues to me, the token holder? Then you're going to find that there are like very, very few protocols where the tokens actually benefit from the money that the protocol makes. One of the best ones, if not the best, is Hype. I would say that Canton is in the top 5 for sure. It might even be number 2. Now, once Canton gets to burn mint equilibrium, I think Canton could just rip higher. So remember, we're talking about connection between protocol revenues and number go up for the token. So, Hype is one of the best, if not number 1. Canton is definitely up there. And then, once you get past Hype and Canton, then you've really got to be taking a look at Tron, TRX. That one, same deal. Another one that's kind of interesting, but with some regulatory risk, is Leo. Unis said Leo. That one is very, very much like synthetic equity. But if there's
we get that deep dive on it, so if anybody's interested in looking into that, you can look back on it. And here pretty soon, as we can get the newsletter dialed in and the merch, dialed in, David's going to be working on the repository for all the deep dives that he does that we're going to offer again at no cost on our website, so that you can go in there like a library, look for an asset that you're curious about, and be able to go through the videos and the slide presentations and all the stuff that David builds out.
Yeah. So in terms of like tokens that actually generate revenue and return it to the holders, there are very few of them. So I'll be really interested to learn a little bit more about Render tomorrow and Near today. I want to learn more about Near's tokenomics today. I've got a bunch of research ready for that one.
And I can't stress enough the importance of learning about the tokenomics of these projects. It's too many people invest in these assets and don't understand the role that the tokenomics have. The connection between the company. And I use it as an example all the time, just because it's one of the largest market caps and it's always talked about. But between Ripple and XRP, is there, understanding that the profitability and success of Ripple, there is no connection to the value of the XRP token other than speculation and hype. And if you don't understand this, please do your own research. Don't just take my word for it. Just like I'm telling you not to take, all the endless posts on social media. I'm telling you, don't take their word for it. Don't take my word for it. Do your own research. But you're going to find that what we teach here is 100% accurate. Is, if the price of a token that has poor tokenomics, that there is no connection, to the revenue generated or the fees generated, by that protocol or chain or company, then the price is pure speculation and can get rug pulled at any time. And more often than not, those organizations during pumps are selling off and in a big way. So,
it's very true.
It's all on chain. All the data is on chain. Don't take my word for it. Go out and find it.
Yeah. It's something that people really need to spend a lot of time researching. Like, you need to know, like, hey, if the tokens that you hold, if those underlying businesses, number one, don't make any money, or number two, make some money but don't return that to you, the token holder, then you're kind of sort of just holding like a meme of that protocol or of that business.
You're wearing the football jersey, or you have the baseball card of your favorite crypto project. It's like, that's really all it is.
And I don't know about you, Mike, but I'm not in the business of holding baseball cards. I need to be able to make money.
Not as an investment, no.
No. Well, I mean, maybe some people are into that type of thing, but when it comes to digital assets, man, look,
the thing
protocol's got to make money.
You just need to understand with baseball cards too, it's whatever the market says it's worth. It has no value in and of itself. It's a piece of paper, but you're counting on the fact that there's somebody that's going in the future going to pay you more for it than you bought it for. And it's the same thing with these tokens that don't have a connection, because these aren't securities. This isn't a stock. There was a whole court case about it. This is not a stock in a company unless it's a tokenized stock. Unless it's like a tokenized Tesla stock or something. If it's an RWA, but most of these tokens, they have no legal obligation to you as a token holder. Again, there's a whole case about it. Ripple.
So Mike, I've got a question for you and for everyone about this, because I'm still a little bit uncertain here. How do you think that Clarity Act legislation is going to treat, those anything outside of the Sweet 16? So there were 16 assets that made it onto that like official digital commodity list.
But honestly, I think that they put them all on a wall, and by all, they put those 16 and they threw darts.
I know. But like, what's going to happen?
It's ridiculous, dude.
Yeah, I agree. But like, what's going to happen to everything else? So if you got a token, just let's use Near as an example. Near didn't make it onto the Sweet 16. So does that make Near a security? And if so, does that mean that you really can't legally hold it in the United States? I don't, if you're a U.S. citizen, like, how is that all going to work? Some questions around that for me.
Time will tell. It's going to be interesting. I'll give it that.
Right. So I see what Keith is saying in the chat. Venice AI uses Near to verify AI privacy. So that's all well and good. What I'm really thinking about here is more along the lines of like regulatory risk, because
he's commenting on a conversation that we had. He said Zcash and VVV are near related, and I just put VVV is an AI play. Zcash is a private store of value, and near, I'll let the deep dive speak for itself. So he's more commenting on that. That he's commenting that there is a connection between near and VVV, which I was unaware of. So thank you.
I think what it is something called near intense. So near pioneered something called intense, or maybe they didn't pioneer it, but they've been able to make use of it. And I think that that's what we're going to learn in that deep dive research later.
And I'm excited to hear about it. It's just, thank you, Keith. No, I mean genuinely, we welcome anybody sharing good information. So if we're wrong about something, by all means, point it out. All right. So let's get into the great ETF rotation. The week of May 18th to the 22nd marked a second consecutive billion-dollar plus redemption window, with spot Bitcoin ETFs printing roughly 1.26 billion in net outflows. However, data highlights that the institutional bid hasn't left the building. It's rotating. Alternative products saw a distinct divergence. XRP and Solana ETFs registered net inflows. Hold on, I gotta sneeze.
Bless you.
All right, thank you. With XRP pulling in 72 million, while Bitcoin and Ether products bled. That is ridiculous to me. Why would they be buying XRP?
I don't know if you can, I can't even believe that. You know what I mean? Like when it comes to like actual XRP news, when someone's bullish on XRP, I think that most of it's either like overstated or a straight up lie, or you might see, buying of a XRP ETF and then someone selling a futures contract against it, if those even exist. I just, there's nothing that could get me excited about XRP. I think that thing is a straight up scam. So yeah.
And the tokenomics, prove it. And the one thing that made me buy it back in the day was the fact that on the XRPL it was the only vehicle to move liquidity, and then they came out with RLUSD, and it was like, oh, okay, well there that goes. So I sold, and I sold at $2.
I think that like there aren't actually any protocols on there. Like you talk about a ghost chain, that is like, the king of ghost chains right there.
Yeah. Well, and with a tens of $billion valuation
for no reason, for doing nothing.
No, it's literally there's nothing going on that chain, and it currently has an $83 billion valuation. For what?
That's the what you were talking about earlier, Mike. If someone buys something where there's no connection to the underlying fundamentals of that business, it's basically a meme. And so, like, okay, you're buying it for what purpose? Well, you're buying it because you think you can sell it to someone else tomorrow for more. That's like literally the definition of some type of Ponzi scheme. So, but if you're buying something because the underlying business generates a ton of revenue and returns those revenues to you, the holder of the token, that's quite a bit different. That's more of a structural bullish thesis for why you might want to swap your liquidity into something like Hyperliquid or maybe Tron.
And that's a fine line because at what point do those projects, from a bearish standpoint, at what point is regulatory bodies going to look at that and say that looks like a security? Because
that's my whole point. Yeah,
if they're paying dividends in some way,
they're not technically dividends, Mike. We got to get away from that language. Yeah, it's more like a burn. It's a burn. Okay.
I get where you're coming from, but as they draft this legislation, what verbiage are they going to use to define dividends? Are they going to say, oh, this is a new asset, and now we're going to consider burns as a way of returning value to holders, and by that definition, it is dividends. You never we've seen them do this stuff before.
I know. So the legalese, that language there, that's going to have to, I think there's going to have to be lawsuits. Like if the Clarity Act makes it through, and hey, we're at the end of May, and weren't all those senators talking about like, we've got to get this Clarity Act done and to the president's desk by the end of May, otherwise it won't happen? Isn't that what they were saying? We got what, 5-6 days left in the month. So hey, it's about time. Are we going to see movement on that Clarity Act or not? And if we don't, that might actually end up being a good thing, simply because the language that I've read in that Clarity Act makes me think that overnight, many digital assets will become, securities under U.S. law. And so those protocols that like exist in the United States that are not on the Sweet 16, those founders are going to have to sue. They're going to have to sue the government so that you can actually figure out like what is legal under this new legislation. What really is a security, and we won't know.
It depends on what your definition of a security is.
It depends on what your definition of is.
Exactly. Slippery Bill.
Yeah, dude. So yeah, you see what Keith is saying. So I actually swapped into, and thank God for this, man. I bought a bunch of these alts over the weekend. I bought Tron, I bought Hype, I bought Near, I bought Render, and I bought Zcash. And
well, thanks for letting me know.
Well, I mean, look, I don't know anything. I don't have a crystal ball.
Powder on the side.
Well, so I'm just
for Bitcoin to go to 50, and
so well, I bought these because I'm short. I'm short Bitcoin and ETH. I actually bought some Bitcoin and ETH here today too, just because I wanted to be able to hedge my shorts a little bit. So yeah, I mean, my plan here is to be able to exit those positions, like hopefully within the next couple of days. I would really like to be able to exit all of those positions in the next couple of days. But, I also price these things in Bitcoin terms. So if I'm short Bitcoin and long Zcash, let's say, and if I see Zcash massively outperforming BTC, well, I like that trade. So, and Zcash, just taking a look at that $700 level, if it convincingly breaks out above that $700 level, it could really rip. That's price discovery mode again. Same thing with Hype. Yeah, same thing with Hype. We get a little bit more upside out of Hype, and I mean, all it's got to do is get up to the highs from yesterday, up above $64.70, and
I've been waiting for a pullback on Hype, and honestly, I'm getting to a point where I think I'm just going to have to buy in. I know as soon as I do, it's going to pull back though.
Well, I mean, I like Tron. So one of my favorites here for like maybe a 20% move from where it's currently trading is Tron. A 20% move out of Tron brings it back to its all-time highs at 45 cents. And I'm not trading any of these, no leverage, just spot.
Well, I already bought a little bit of Tron. I'm up about 12% on my Tron purchase, and my Tau. I bought some Tau, and I'm up about 14% on that. So, but I bought those like a couple weeks ago. So, I mean, not a ton, but I'm up.
Yeah, and taking a look at something like Near, if I just look at the technicals on Near, it tells me that it runs to $3.33. If I'm just looking at the technicals, and then, hey, if that thing gets above 333, then I mean, at that point, all bets are off. It could really, really run. But that's why I want to learn more about the tokenomics. I know next to nothing about Near's tokenomics. I also picked up some Render. It's a technical breakout. I see Render breaking out, and I think $2.70 is in play, or maybe even a little bit higher. So I have literally been buying coins where either number one, like in the case of Hyperliquid and Tron, they generate a ton of revenue and return those revenues to token holders. Great tokenomics. Or in the case of Near and Render and Zcash, the technicals look really, really good. And then I'm short Bitcoin and ETH, but I bought some Bitcoin and ETH to hedge those shorts. So if there is, a push back up towards, for Bitcoin, a push back up towards its 200-day moving average, at least I'm hedged. And same thing with that, for Ethereum. If Ethereum is able to push a little bit higher, I just, wanted to hold some spot ETH to be hedged a little bit there too. But, as far as like a longer term,
I want to say welcome first of all. So this is one that I haven't heard about in quite some time. I mean, would you mind pulling up a chart on CRO?
Cronos. Yeah, it's been a while.
Yeah,
Let's see what we got going on here. Oh, not much. Nothing doing over there. Let me share my screen here. We can take a look at this one. Okay, so CRO, Cronos. Let's see what we've got going on here. So this is a daily, and I just want to zoom out here on the daily so we can get a little bit more data. Why don't I zoom out to the weekly, actually? And let's just, whenever in doubt, zoom out. Okay, I want to get all the data on the screen here. Okay, so what levels do I have? So it looks like I've got drawn in on Cronos from a while ago, the bear market lows from the end of last bear, beginning of the last bull market. Got a couple of pumps out of Cronos, higher highs, and it didn't really make a series of lower lows. So that's, potentially a positive thing. You got a series of, 4 higher highs here. That's positive. It hasn't broken down below its bear market lows from last bear. That's also a net positive. But it was unable to make fresh all-time highs compared to the bull from 2 bull markets ago. So this is last bull, and this is, the bull before that. So yeah, when I'm taking a look at Cronos, I don't really see anything to get excited about here. And then if I zoom in here to a daily, and we just take a look at this on the daily, there's that 200-day moving average. It was during that pump throughout, the beginning of this month of May, it was unable to make it even up to the 200-day moving average there. So that is definitely not bullish. Now, could this see another move to the upside? Sure, of course it could. Do I have a crystal ball? No, I don't. But there's no reason for me to get excited about this one.
No, it's not something I'm going to go, building a bag of or anything like that. Not to say that you can't make money off of it, but not something I'm interested in.
Nah, I'm going to have to pass on this one. So yeah, but there are some that I'm interested in here. I mean, Hype. I've seen a lot of people comparing Hype to BNB, and that kind of sort of makes sense to me.
Well, we only got 7 minutes left before the deep dive, so there's a couple of news articles I want to cherry pick out of here. Corporate and sovereign positioning. Spot prices found critical support midweek after MicroStrategy disclosed a massive $2 million purchase, absorbing roughly 25,000 Bitcoin between the 11th and 17th of May to stabilize the floor amid broader geopolitical sell-offs. Concurrently, a revised U.S. strategic Bitcoin reserve bill hit the legislative circuit, notably dropping its aggressive 1 million BTC upfront purchase target, but introducing a rigid 20-year sovereign lockup period. And we talked about this last week. Let's see. So security researchers have flagged a sophisticated active malware campaign dubbed Trapdoor. The campaign is aggressively targeting crypto developer environments across the Aptos, Sui, and Solana ecosystems, attempting to compromise protocol code bases at the root. Good information to have.
You got to be on your toes. Those hackers sure are.
They're crafty little bastards. All right. On-chain yield and VTFs, structural yield innovation, took center stage at recent industry events with the debut of the first on-chain Bitcoin yield vault traded funds, designed to capture institutional options premium strategies directly on-chain. This mechanism signals a broader structural shift where the back end of asset management increasingly looks like permissionless smart contract vaults rather than legacy trusts. You care to decode this, David?
I don't know what the hell any of that means.
All right.
Can you share the article real quick so that I can actually read it? Because
It's a very very lengthy a video clip of basically an event. So it wouldn't do any good. We'd have to sit and watch the whole thing.
okay, so it sounded like a permissioned vaults. Is that was the takeaway there? Because
Yeah,
those are actually quite interesting.
the first on-chain Bitcoin yield vault traded fund, or VTF.
VTF, Vault Traded Fund.
It says
Huh.
it's designed to capture institutional options premium strategies directly on chain.
That actually does sound very interesting. Because I can imagine how that would be constructed. Like imagine you've got a vault, maybe on an Ethereum chain, let's say, and that vault contains a Bitcoin derivative. And then you take that permission vault with Bitcoin, that Bitcoin derivative in it, and you create like an ETF, or this is called a VTF. You create a VTF product. And so I'm assuming that VTF product is something that you can trade in TradFi, because if they're talking about options, you need a lot of liquidity, a lot of volume for those options to be liquid enough for you to actually be able to trade them. So, which company is launching that? Is it one of the big ones?
Um, it doesn't say in this. You might have to look that up if we wanted to dive deeper. We only got a couple minutes. Let's keep moving. We can stick a pin in that and maybe do a deep dive on it. Um, let's see. Tether expansion. Undeterred by the U.S. legislative standstill, Tether has announced plans to launch GELT, GELT, a new stablecoin backed by the Georgian government, aiming to secure. What the hell? Let's not even get into that.
So you're talking about Georgia, like Eastern Europe, Georgia?
Yeah. So let's actually, you know what? Let's watch this video real quick. And
awesome, let's do it. So before we do, I've got okay, what's that?
There, check it out. Let me know if you can't hear it.
No, I can hear it.
On Wall Street, the debate over digital assets has officially shifted from if they matter to how to integrate them. TradFi giants are moving beyond the proof of concept phase, even executing live production use cases like weekend repo trading with tokenized treasuries. Now, this convergence is creating a complex balancing act. Institutions want the efficiency of programmable assets as well as quote, golden records, but they demand strict privacy and governance that public blockchains lack. And added the reality of ongoing DeFi exploits, the looming threat of quantum computing, and a rapidly shifting AI startup landscape. And navigating this next frontier does require serious discipline.
Hey, Mike, is there any way that you can turn up the volume on your end a little bit?
Blockchain and AI is Stephen Willinger, founding partner of Blockchain Builders Fund. Stephen, great to have you here. Thank you so much for joining me.
Thank you for having me.
Well, here on Wall Street, we're paying attention to institutional adoption and that intersection of TradFi as well as DeFi. So given some of these cyber risks out there, where are your concerns right now?
Yeah, I mean, it's been a kind of hectic month for cybersecurity attacks, both inside Web3 and outside of it. And it probably has something to do with the sort of like democratization of AI tools for both coding, and also coding is just another way to build a breach. And so I think it raises a lot of question about like how much decentralization is good. Having some centralization and control allows trusted third parties to mitigate issues, right? So we've had a couple of hacks this week where if there had been some sort of cool-off period for large transactions and a governance body that could have reviewed those transactions before the funds went out, it potentially could have been stopped. So I think this is going to give pause potentially to institutions who are considering deploying onto highly permissionless and irreversible blockchains, and considering other blockchains like Canton, where governance is more baked in to the mechanism.
And there is the technology aspect of this as well. So we're continuing to see innovation, but with that also comes compliance as well as regulation. So tell us what the vault is.
Yes. So a vault is a good way to think of a vault is an asset manager. However, it can be structured in a way where technology takes the place of a lot of the back office of an asset manager, right? So a vault allows you to put assets into a vault and have a strategy executed by a manager. However, there can be guardrails placed on that strategy such that you only have to put a certain amount of trust in that asset manager. And this is quickly becoming the format in which crypto assets are deployed to earn yield, and that yield can come.
So this is the like Morpho is a perfect example of this, where it consists of curated vaults from institutional organizations that have a long history in TradFi of managing portfolios and managing liquidity, and also the fragmented liquidity model, the architecture that is much more in line with what institutions want, as opposed to Aave, which we saw in recent weeks, that where they pooled all the liquidity together, and that allowed for that two to $300 million of liquidity being sucked out of the market, or sucked out of Aave, from that RS ETH exploit. So this is the more the model that institutions are moving towards, and they're voting with their liquidity. They're voting with their feet, and we can see where that liquidity is going. You had something to say, David?
Yeah. So it looks like this is actually not going to be on public chains at all, and instead these vaults are on Canton. That's what I took away from this. Yeah.
From any assets available on a blockchain, and so I think you'll see a lot of trends where the back end for asset management will start to look more and more like vaults, and you'll get a greater diversity of asset managers able to use this technology, and ability for investors to go ahead and enter into those strategies. So I think it's very much going to converge, and it'll likely have a lot of the trajectory that ETFs did. We're early on. It's a new packaging, but the cost is low. You get great transparency and visibility into how the asset managers are managing your assets, and great guarantees about what they're going to do, so you know exactly how you're exposed.
Yeah, and while I have you here, I do want to ask you about quantum. So there has been a lot of debate regarding the risks of quantum computing on digital assets and what it means. So what are your concerns about Q-Day? And do you think a lot of this is hype similar to Y2K?
Yeah, I think the Y2K comparison is a good one. The Q-Day keeps moving forwards, right? The technological breakthroughs are coming faster, I think, than folks expected. Recently, Google and some Stanford researchers, and I think some folks from the Ethereum Foundation, were able to prove that you needed way less quantum computing power to do basically the algorithm that would break the cryptography, and not only crypto, but a lot of the things that manage like messaging, and also compute from government to corporate. So that day's moving forward. Fortunately, it's not tomorrow. And I think everyone is now aware of this issue, and it's a relatively straightforward fix, with a lot of the quantum-proof cryptography already being known. A couple of the issues outstanding, though, especially for the crypto industry, especially have to do with Bitcoin, where it is very hard to update the Bitcoin network, and perhaps more importantly, for this particular upgrade, there are a lot of Bitcoin sitting out there that would need to be migrated, and the owner of that Bitcoin, especially Satoshi's Bitcoins, is not known and may not even be around anymore. So there's going to be a big, once again, governance decision for the Bitcoin community, what they want to do with those tokens. Do they want to leave them exposed and allow them to potentially be stolen? Do they want to burn them? Do they want to silo them off and create some claim process?
That concerns me. I mean, we've talked about this. Bitcoin is supposed to be fully decentralized. It's supposed to be able to, basically where nobody, can, seize it. Nobody can, steal it from you, as long as you're not, as long as you don't do anything stupid, as far as click on the wrong thing. But what they're talking about is native Bitcoin, being able to just vote and burn Satoshi's Bitcoin just because they don't know if he's still around or not. That to me is not very bullish, and I mean we call all the shots here, when it comes to positive and negative. And that to me is not a bullish sentiment that anybody, or group of people can just say, oh yeah, this wallet, we're just going to burn their tokens.
Yeah, right now I think that there are a couple of BIPs, Bitcoin. I think they're called Bitcoin improvement proposals um, uh, around quantum. And so the argument here is that if you've got a million or maybe 2 million coins or maybe more, I think I've read it up to maybe 4 million coins that are exposed to quantum. Um, yeah, it's BIP 360 exactly. So if you've got all these coins that are exposed to risk of being stolen or moved as a result of quantum, how do you mitigate that risk? And so there's a couple of ideas being floated around there, but
It's for the children. It's for safety. It's for the
I mean,
children.
yeah. So but what would happen if those million BTC in Satoshi's wallet were suddenly moved? What's going to happen if a quantum actor is able to move those coins?
But is it decentralized? If
Well, so it is, but
there
at
could
the
be
same
a
time, it's
if there could be
software.
but
Well,
if there could be a BIP that can just reach out and burn my tokens that I have sitting in a wallet, is it
oh
truly
yeah,
you know
no,
what I mean?
that's a problem.
Yeah. I mean that's my only point is just that
Yeah.
I could hold Bitcoin forever safely in cold storage and nobody could touch it. But I guess that's not the case.
Well, so there have been a lot of Bitcoin improvement proposals that have passed, where there have been changes to the Bitcoin protocol. It is a piece of software. It is the only, well, maybe not the only one, but it's definitely the largest decentralized commodity. I think that there are probably at least two others that are like truly decentralized. But yeah, man, it's interesting to think about, what's going to happen to the Bitcoin protocol if quantum actually materializes, becomes a real threat. What are people going to do to secure their coins on Bitcoin mainnet? I don't know, but
Well,
there's going to be a fight for sure.
let's use this to segue into the Bitcoin deep dive. Just right off the bat, is I'm really interested to hear about and educate everybody that maybe doesn't understand the difference between native Bitcoin on Bitcoin mainnet and these synthetic or wrapped versions. So
Sure.
and then
Yes.
and what cued this off in my head, it was again, I was hearing rumors that supposedly, and we've heard that, supposedly there was going to be native Bitcoin on Cardano, and I heard grumblings that there was going to be native Bitcoin on Base, and so I kind of want to. I asked David if he could do a deep dive and basically educate me and those of you out there that maybe don't understand, like myself, if is this even possible? So go ahead.
Yeah, so the answer is no. But we need to be aware of all of these different Bitcoin products, right? You've got centralized Bitcoin products that are backed by some corporate entity. You've got decentralized Bitcoin products that are cryptographically backed. You've got liquid staking Bitcoin products that are yield bearing, and then you've got synthetics and derivatives too. So when we're talking about the corporate backed centralized stuff, we've got WBTC, wrapped Bitcoin. That's one of the biggest ones. You've got CBBTC, that's Coinbase wrapped Bitcoin. You've got Circle's product, CIR BTC. And then you've got another one, FBTC. So the mechanic here is that these are all one for one backed with off chain regulated reserves. So if you're holding one of these tokens, and there's a problem with your counterparty, let's say that BitGo, we've seen all sorts of exploits and hacks and stuff like this, but
Well,
imagine
that RSE, freaking. What I think that's a liquid restaking ETH. We saw what happened with that. It's a wrapped version of ETH, and it got exploited to the tune of about $300 million.
yeah, no, it did. And so that's like an LST, but imagine if you're holding WBTC. Like, I've got I'm short Bitcoin, but I wanted to hedge myself because I think that we might move a little bit higher in Bitcoin and ETH today or over the next couple of days. So, I bought some BTC to hedge my short. And the BTC that I swapped into on ETH mainnet is WBTC, wrapped Bitcoin. So if there's a problem with BitGo, the custodian, that WBTC could depeg. So, you've got to be careful of what you swap into. You've got to be thinking about what's the liquidity for me to be able to exit this thing. So yeah, these centralized corporate backed tokens, you've always got to just understand that this is not spot Bitcoin. Like if you hold WBTC or CBBTC or CIRBTC or FBTC, you don't actually hold spot. You hold something that's technically backed one for one with spot, but you're taking on risk. Okay, so there is definitely quite a bit more risk in holding one of these than holding one of these corporate-backed tokens than there is if you're just holding spot Bitcoin on the Bitcoin mainnet. So that's number one. Number two, you've got this decentralized or cryptographic BTC. So this is Threshold's product, TBTC. So this one is a multi-party elliptic curve. That's the encryption algorithm. So multi-party elliptic curve network with no corporate entity. So this one is backed by a cryptographic peg. Over here, you've got these liquid staking tokens, yield-bearing versions of BTC. One of the largest of them is Solve BTC. Another big one is Lombard BTC. Of course, you've got Pump BTC also. And so the mechanics here, it secures external proof of stake networks like Babylon while retaining its Ethereum virtual machine composability. So basically what happens is you take your spot Bitcoin and you essentially almost like lock it into a contract, which then mints this LBTC or Pump BTC or Solve BTC on an Ethereum virtual machine chain, or I think also on Solana. And it might also exist on Sui, these derivatives here. So if you're holding one of these derivatives, they are like LSTs, they're yield bearing, but like the amount of yield that you earn on these things is like negligible. So you could, if you're very skilled, potentially use those Bitcoin LSTs and then borrow, a Bitcoin, like maybe a corporate-backed version of Bitcoin against them, and then loop that, and you'd just be running an interest rate arb, and you'd also be long a little bit of Bitcoin. So that could potentially be an interesting play, but you've got to make sure that these tokens don't have a history of ever depegging. So it danger there for sure. And then you got these synthetics, right? And derivatives. So SBTC, that's synthetics with an X product. A GMX has a synthetic, Derive. I don't know that Derive really has a synthetic. I'd have to check that. And I'm not familiar with Copra. I'd have to take a look at those. But the mechanic here is, on-chain price exposure and fixed yield debt without underlying physical custody, because these are synthetics and derivatives. So now that we've gone through and just learned a little bit about the different types of Bitcoin outside of like native spot Bitcoin, why don't we take a look at this piece of video content? This is 9 minutes long. So Mike, I'm going to go ahead and hit play here. Let me know if you can't hear this thing.
Can't hear it.
Okay, gotcha. So let me go ahead and stop my screen share there. I'm going to start this thing back up. And what we're going to do here is we're going to learn about the EVM Bitcoin landscape in 2026, all of these Bitcoin products.
Game changer in the crypto.
Here we go.
Welcome back to The Explainer. Okay, get ready because today we're diving into a literal game changer in the crypto landscape. We're going to look at how Bitcoin has completely transformed in 2026. It's no longer just sitting idle in cold storage. It's been wrapped, staked, and leveraged into an entirely new, highly complex on-chain ecosystem. Okay, let's dive into this. By early 2026, the macro environment brought some serious fireworks. I mean, following 3 rate cuts by the Federal Reserve, we saw Bitcoin blast to a staggering all-time high of $126,000. But what's actually even more fascinating than that shiny price tag is what happened under the hood. This huge price surge catalyzed a massive 75 to only billion-dollar DeFi lending market. Bitcoin literally became the core engine of a hyper-productive financial machine. So here's our roadmap for today. We're going to map out this complex new geographic territory of on-chain Bitcoin step by step. We'll start with the new Bitcoin economy, break down the 4 tokenized asset classes, look under the hood at custody and cryptographic plumbing, explore the L1 versus L2 divide, and finally wrap up with the risk matrix. All right, starting off with section 1, the new Bitcoin economy, moving from passive to productive. We really need to understand the exact macro catalyst that changed Bitcoin's fundamental utility. And well, that catalyst has a very specific number attached to it, $4 billion. That's the total
What's that, Mac?
The style this thing uses, is there a way to not use like the little cutesy stuff? It like really distracts from the seriousness of the topic.
Yeah. So I can only create 2 types of cinematic content each day. And so this one was actually one of the last pieces of research that I've produced.
Defaults to
this. So the
cool.
near one's going to look pretty good, and that alchemy one should look pretty good too.
Stone that the Babylon protocol hit, and this was massive. This single protocol unlocked native staking directly on the Bitcoin base layer. It completely, and I mean completely, ended the era of Bitcoin just acting as a passive store of value. Holders could finally put their assets to work securing proof-of-stake networks, and the best part? They didn't have to give up base layer self-custody. It's like your digital gold finally stepped out of the vault and started earning a wage as a digital worker.
Yeah, I mean, kind of, sort of. But, if you take your Bitcoin and stake it on Babylon and then receive, one of those Bitcoin derivatives, in order to get your spot Bitcoin back, you've got to basically burn that Babylon BTC. So, yeah, and the yield that you earn, is it worth it? Is it worth taking on that smart contract risk? I don't know.
Moving right along to section 2, 4 tokenized asset classes. Let's look at the ecosystem map. Now, we're going to break down the exact token types securing this new economy, just so you don't get completely lost in the alphabet soup of tickers out there. We can realistically chunk this entire ecosystem into 4 distinct buckets. On the centralized end of the spectrum, you've got institutional grade tokens like WBTC and Coinbase's CBTC. Moving down the line, we hit decentralized bridging tokens like TBTC. Then we enter the really fun, yield-bearing frontier of liquid staking tokens. Think Lombard's LBTC. And finally, we have synthetic and derivative products like SBTC and GMX. So you're looking at a whole spectrum here, ranging from heavily regulated corporate tokens all the way out to highly leveraged permissionless derivatives. When you look at the dominance in total value locked here, it reveals a super fascinating story. Legacy wrapped Bitcoin, WBTC, still holds a massive $9.1 billion lead, really clinging to that historical moat. But man, the challengers are closing in fast. We're seeing this rapid multi-billion-dollar rise from Coinbase's CBBTC, which is already sitting at $2.5 billion, and Lombardo's liquid staking token, LBTC, quickly scaling up to $1.5 billion. The gap is definitely closing. Now, you might be wondering, what exactly is an LST in this context? Liquid staking tokens represent deposited Bitcoin that is actively generating native yield by securing external proof-of-stake networks. Lombard's LBTC is the prime example here. You get this token representation that you can plug right into DeFi to generate yield, while your actual underlying Bitcoin is out there working for you.
Okay, so I kind of take issue with this. Your spot Bitcoin, in order for it to secure a proof of stake network, we would need to really do deep dive research specifically on that. How is it that spot Bitcoin can secure an EVM chain, like Ethereum, a proof of stake network like Ethereum? Whatever the complex, math is, the cryptography behind the scenes, I just don't know if I buy it, to be completely honest.
And again, you do this without sacrificing that crucial base layer self-custody. You get the liquidity and the yield at the exact same time. It's a real win-win. Let's move to and see how this builds in section 3, custody and cryptographic plumbing. To really grasp the security here, we need to look under the hood and see how these billions of dollars are actually secured and verified behind the scenes. it fundamentally boils down to centralized versus decentralized custody. With the centralized wrappers, you're relying on legal off-chain trust structures. For instance, Coinbase's CBBTC relies on their incredibly strict NYDFS-regulated Coinbase Prime Trust. WBTC uses a federated merchant model anchored by BitGo cold storage. But then contrast that with decentralized networks, like TBTC. They completely strip out the corporate custodians. Instead, they use multi-party cryptographic coordination, specifically 100 rotating ECDSA signers to govern the native Bitcoin wallets. Because in decentralized systems, fallback procedures are written directly in code. Trust is replaced by economic penalties. With TBTC, the protocol uses a 51 of 100 threshold signature model, meaning no single party can just run off with the Bitcoin. But what if the signers fail or try to collude? Well, if those 51 signers fail to process user redemptions, their locked T-utility token is systematically slashed to compensate the user. It's just a brilliant alignment of economic incentives. So how exactly do liquid staking platforms handle this? Let's walk through Lombard's vascular drawbridge minting process. It's a fascinating 4-step flow. Step 1, a user deposits layer 1 BTC. Step 2, a 15-member security consortium generates a cryptographic signature attesting to that specific deposit. Step 3, and this is where the magic happens, an off-chain coprocessor called the drawbridge independently monitors the Bitcoin blockchain to perfectly match the deposit. Finally, step 4, only when that deposit is independently validated does the smart contract actually allow the EVM token to be minted. This basically guarantees every single deposit is verified, preventing unbacked tokens from ever entering circulation. And this brilliantly illustrates how the space has evolved. Instead of waiting around for monthly corporate accountants to verify balances, we have dynamic formulas, like the Redstone Oracle, running every 20 minutes to prove full backing right on chain. It factors in total balances, pending unstakes, and unclaimed tokens, dynamically capping the price ratio at exactly 1.0. This ensures the asset is always over-collateralized, or at the very least, fully backed in real time. Moving on to Section 4, the L1 versus L2 divide. We've covered the plumbing, but where do these assets actually live? Well, the ecosystem has fundamentally bifurcated into a tale of two very different chains. We are seeing a massive geographic split in liquidity here. On one side, you have Ethereum mainnet. Think of this as the fortress. It acts as a highly secure, high-fee vault that's heavily favored by institutional whales who are utilizing legacy protocol modes like Avi v3 and Sky. But then on the flip side, we have base layer 2. This is the high-speed, literally zero-gas ecosystem that's absolutely dominated by retail traders chasing high-velocity yield on decentralized exchanges like Aerodrome. Two entirely different playgrounds for two entirely different types of players. And I have to say, the yields on base are just incredibly compelling right now.
Okay, but you got to understand what these are. So these are liquidity pools on Aerodrome. Okay, and this is not just Bitcoin. So you got Bitcoin
weird token called Edge.
right. And then you got whatever, seed beta is, and then you got MET, whatever that is, and then you got XRP. So these yields, these are just liquidity pools where you've got the Coinbase wrap Bitcoin product paired with some other high volatility altcoin. So I would
and if you don't understand the mechanics of liquidity pools, we have a bunch of no-cost education in DeFi University that explains how it all works and why, me personally, I wouldn't touch any of these with a freaking somebody else's wallet.
No way.
Coinbase essentially built a native gasless pipeline directly to base L2, and it is fueling massive liquidity on platforms like Aerodrome. Just look at this. The CBTC Edge pool is pulling in an annualized yield of 9.39%, while the MET CBTC pool is generating a massive 14.00% APY.
Oh, I remember what MET is. MET is metronome. That's one of these like derivative synthetics on the base chain. Yeah, you can't touch any of this stuff.
That is high velocity, double-digit yield enabled entirely by the sheer transaction efficiency of layer 2.
No, it's not.
All right, finally, let's hit Section 5, the risk matrix.
We'll call it out, even with the material that that we generate and stuff like that. We're going to point out the the positives and the negatives.
Yeah, so the reason why this is not real is, okay, so let's say that you got your spot Bitcoin, or you start with your spot Bitcoin, and then maybe you stake it on one of these LST protocols like Babylon or Solve. And so now you've got this Babylon BTC or this Solve BTC, and you bring that, now you've got that on an Ethereum chain. So maybe you've got that on mainnet, and maybe you want to swap that for Coinbase Wrap Bitcoin on the base chain. So you've got all of these different swaps just to get into Coinbase Wrap Bitcoin, CBBTC. If you're starting with spot Bitcoin. And then, okay, so great. Now you've got the Coinbase Wrap BTC product. And then if you pair it with Edge or Metronome or XRP or whatever BATA is, these are super high volatility alts.
Coinbase wrapped Cardano, basically. Coinbase wrapped.
Gross. Yeah. So if you pair with any of this dog shit, then these yields don't matter. And also, you're getting paid those yields. You're getting paid in Arrow, which is I know, Mike, you like Arrow. I don't, and so I don't want to earn Arrow, and so these yields are basically meaningless.
Then you just earn Arrow and swap it.
Yeah, but if you're in the pool, then you're exposed to the other alt.
Oh, so, yeah, absolutely.
Yeah, no, so these pools you want to avoid. Yeah, I would avoid these the plague.
The pools that I'm in on Arrow, I'm earning Arrow, and if I and I have a very nice bag of Arrow, so most of it, whenever I do redeem it, I swap it into Bitcoin or I swap it into USDC or whatever. So yeah, I just wait for pumps. Whenever Arrow pumps, that's when I'll pull out whatever I've built up and swap it into something else.
For sure.
Entirely by the sheer transaction efficiency of Layer 2. All right, finally, let's hit Section 5, the risk matrix. What could go wrong? We need an impartial analysis here, because let's be real, there is no free lunch in crypto. Every single yield strategy carries its own unique technical vulnerabilities. We can systematically outline the specific risks for each asset class right here. Centralized wrappers, they face off-chain counterparty risks, custodian bankruptcy, or sudden regulatory asset freezes. Decentralized bridges, on the other hand, face the ever-present threat of smart contract exploits. Liquid staking tokens are exposed to validator slashing on proof-of-stake networks like Babylon if consensus rules are somehow broken. And lastly, there's the constant, looming threat of secondary market depegs for LSTs during periods of extreme market volatility.
Okay, so these are all real risks. These are serious risks. Any of these risks by themselves, any one of these by itself, would be enough of a reason to not swap your spot Bitcoin for some, a derivative product or corporate-backed Bitcoin product or decentralized Bitcoin product or Bitcoin LST. I don't even think that's really a thing, to be honest. But, any one of these by itself would be a good enough reason not to take your spot Bitcoin on the Bitcoin mainnet and, through some complex process, swap it for something else. So yeah, I would, you really got to read up on these failure vectors. You always have to be thinking, what's the risk before you start thinking about how much you could make in yield or some DeFi play you could run with that Bitcoin derivative. Just think about the risks first.
Usually the higher the yield, the higher the risk. It's either a brand new platform that's trying to get liquidity, or it's a shitty asset, a shitty pair. It'll be like 2 meme coins or something like that, but that's going to offer 3,000% APR that you might make for 5 minutes, and then one of them gets rug pulled or something like that. So you need to understand the mechanics. You need to understand the underlying assets. You need to understand the relationship between the underlying assets. You need to understand the tokenomics. You need to there's so much you need to understand before you deploy liquidity into these pools and into DeFi. Again, it's why we started this channel. It's why David built DeFi University, and we offer it at no charge. We want you to understand what you are investing in and what you are doing before you deploy liquidity.
Liquidity.
Anchor these abstract risks to a concrete example. Let's look at what happened on September 26, 2025. The Bedrock Liquid Restaking Protocol suffered a $2 million exploit. Basically, An attacker realized they could exploit a simple validation bug. They deposited highly discounted wrapped Ether instead of actual Bitcoin to infinitely mint the UniBTC token. This perfectly proves the extreme hazard of relying on naive cross-chain contracts without independent state verification. Literally, one tiny bug can drain millions in an instant. So the crucial point is understanding liquidity mismatches. Here's how it works. If you hold an LST like LBTC, you can trade it instantly on a DEX. Awesome, right? But primary redemptions, meaning actually getting your native Bitcoin back, require you to burn the EVM token and wait out a 7 to 9 day Babylon unbonding period. If panic selling hits the secondary market during a crash, that delay can cause severe depegs. And if the token depegs significantly below its one-to-one value, it can trigger massive loan liquidations across lending platforms way before users can actually unbond their underlying Bitcoin. It's a cascading effect. Which brings us to the ultimate question for the future of on-chain Bitcoin. As we look ahead, will heavily regulated institutional custody or high-velocity decentralized yield ultimately win the on-chain economy? Or, is there a middle ground? The convergence of compliant, bulletproof custody and native decentralized yields will absolutely define the next era of Bitcoin. It's a totally fascinating, highly complex space to watch. And now, hopefully, you've got the structural map to navigate it. Thanks so much for joining me on this explainer. Keep learning, and I'll see you next time.
Yeah, so some of the core takeaways for me from that research were all about the risks of holding one of these Bitcoin products. I would prefer to hold spot Bitcoin, but there's a place for those Bitcoin derivatives. Just be aware of the risks. You got to go in eyes open. Okay, so this next piece of research here, Mike, that I want to take a look at is all about near protocol. And so before we dive into that, let's just take a look at the chart here, because this is a pretty compelling breakout. So you've got the all-time highs back here at, what is that, $21 or so. You've got a lower high. And so if I just connect these lower highs together, gives me a level of trendline resistance. And then if we zoom in a little ways here, you'll be able to see that there was actually a really nice technical breakout just a couple of days ago for near. So it basically was clinging to that after pushing higher, held on to the 200-day moving average, and then nice blast off from $1.50 to right now $2.75. So this is a breakout above this level of trendline resistance. And so now that it's broken out like this, the next level of resistance comes in up here at $3.33. If it can make it up there and actually break out above $3.33, then, at that point, the trend will have convincingly shifted from bearish to potentially we're starting to see a swing to the upside, but it hasn't happened yet. And so what we really need to see is a breakout above 333. You get a break above 333, and then you could start talking about $8, but we're not there. And it's still a Bitcoin bear market, so a little bit dubious here, but this has definitely been a nice run. So let's take a look. Let's learn a little bit more about near. Let's see here. This should be a nice piece of content. Let's check this out. Mike, let me know if you can't hear this one.
All right.
By 2026, the Near protocol operates as a single distributed state machine, processing millions of transactions across a dynamic, sharded landscape. Operating alongside monolithic execution environments like Solana, Near routinely supports between 3 and 5 million daily active addresses. This dashboard captures the network's 2026 baseline. Block times hold steady at 400 milliseconds with finality under 2 seconds. Execution costs hover under half a cent. Crucially, this efficiency is resilient. On this overlay, even during severe utilization spikes, the gas fee remains flat. Horizontally scaling a distributed state machine typically forces a rigid trade-off in distributed systems engineering. To increase capacity, you either expand local node requirements, crushing validators under impossible physical hardware bloat, or you fracture the network, causing it to grind to a halt from cross-shard communication latency. Near bypassed this trap through a multi-year architectural evolution, culminating in two specific mechanisms: stateless validation and dynamic resharding.
Through these upgrades, NEAR effectively redesigned the distributed state machine, completely decoupling state storage from execution to align high throughput with native token scarcity. The foundational scaling primitive of NEAR is Nightshade. Its defining characteristic is that it entirely avoids the isolation of separate blockchains. Instead of fracturing into independent chains, Nightshade treats the network as a single environment where only state transition logic is divided. This parallel block production mechanism is executed by creating chunks. As shown here, a single block is divided into parallel segments that distributed validators process simultaneously. Initial rollouts expanded processing capabilities and decoupled block validation from chunk production. However, these early phases operated under a critical limitation. As this model illustrates, despite the divided state, validators were still strictly required to track all shards in their local memory. This local tracking mandate triggered rapid state growth, requiring massive amounts of local memory and making node operation financially prohibitive. Because only well-capitalized operators could afford the necessary hardware, this physical memory demand placed a hard mathematical cap on the network's ability to decentralize. While basic sharding temporarily solved throughput constraints, it simply transferred the bottleneck from the network software directly to the physical hardware of the validator set. In the second quarter of 2024, NEAR engineers deployed a structural overhaul known as Phase 2. This upgrade introduced stateless validation. The core mechanical shift of Phase 2 was the absolute decoupling of state storage from block validation. Validators are no longer required to store the full historical state of a shard locally. The heavy storage burden is completely removed. Instead, the network verifies state transitions using cryptographic witnesses. These compact state proofs replace the massive local database, drastically lowering hardware requirements. By lowering the barrier to entry, stateless validation drove a surge in decentralization, leading to an expansion in transaction volume and millions of new wallets generated by mid-2024. Yet removing the physical hardware barrier and pushing the network faster immediately exposed a hidden mathematical software limitation. In 2025, the core engineering team launched the 1 million TPS research initiative to stress test the network's absolute limits. The professional expectation in distributed systems is straightforward. Adding more horizontal shards to a network should result in a linear, proportional increase in transaction throughput. This chart reveals the central anomaly. We expect a straight 45-degree line of linear growth. Instead, as the shard count scales, actual performance severely flattens out into sublinear growth. The gap highlighted in red identifies the specific force dragging performance down: cross-shard communication overhead. The latency required to coordinate message passing between isolated shards actively degraded the net throughput gains of the system. Consider a practical scenario. A single highly popular decentralized application suddenly experiences a massive spike in user traffic. This localized traffic surge rapidly congests a single shard. Because the application's state is bound to that specific location, the remaining capacity across the rest of the network shards is completely useless to those users. Without a mechanism to balance localized data spikes, traditional sharding hits a hard sublinear ceiling, trapping the entire network in coordination latency. To resolve this localized congestion, NEAR deployed NEP 616, introducing sharded smart contracts in late 2025. This upgrade capitalizes on the unique NEAR account model, where every single user account operates as an independent smart contract. Because of this architecture, a single application is not trapped in one location. Its user balances can be distributed across distinct shards simultaneously, perfectly balancing the load. This optimization enabled Phase 3, dynamic resharding. The protocol monitors state size and throughput. When a shard crosses a predefined utilization threshold, the network reacts. The congested shard automatically splits internally within a single block, distributing traffic across two new shards. Historically, increasing the number of shards required developers to schedule and coordinate manual protocol upgrades 1 to 2 months in advance. Phase 3 bypassed the sublinear trap. Isolating performance spikes and scaling horizontally on demand, NEAR enabled throughput to expand alongside demand without requiring manual validator intervention. With the technical infrastructure finalized, the community upgraded the cryptoeconomic engine via consensus version 82 in late 2025. They executed the halving upgrade, cutting the maximum annual inflation rate from 5% to 2.5%. This strict reduction directly protected non-staking token holders from aggressive dilution. To offset the remaining inflation, this flowchart shows how NEAR enforces a strict transaction fee allocation. 70% of every fee is routed to a programmatic burn, permanently removing those tokens from supply, while 30% is routed as a developer rebate.
Okay, so this is the type of stuff that we're looking for. We want to see some type of aggressive burn mechanism. This is good.
This 30% rebate operates as a direct financial incentive, rewarding developers who build high-utility, gas-consuming smart contracts. To amplify this deflationary pressure, a secondary economic loop was activated, the fee switch and buyback mechanism. Fees generated from cross-chain NEAR intents bypass standard routing. They are channeled directly into open market buybacks of the native token, feeding right back into the programmatic burn.
Wow, see, that's great. So all of cross-chain swaps generate...
That's solid tokenomics.
There we go.
This dual monetary model establishes a direct, programmable link. As chain abstraction services and transaction volumes scale horizontally across the network, the native token scarcity automatically scales with it. By mid-2026, the ecosystem running on top of this architecture is driven by several consumer-facing pillars. Sweat Wallet remains a massive retail onboarding engine, commanding over 10 million active users. It leverages chain signatures to enable users to interact directly with external networks, using Sweat to cover gas fees on target chains to simplify the multi-chain experience. But this comparison visual highlights a clear divergence. While the left bar shows millions of highly active daily users, the right bar shows a total value locked resting between $250 to $350 million. This data discrepancy proves that while NEAR easily processes high-value microtransactions and retail activity, it captures significantly less deep speculative capital deposits than its competitors. Native decentralized financings like Burrow and Rhea Finance actively attempt to correct this, holding roughly $150 million in TVL and capturing liquid staking tokens to anchor capital on-chain. As the network achieved structural maturity, it also completed its final transition of power, shifting control from the NEAR Foundation directly to the community-driven House of Stake platform. The House of Stake abandons simple liquid token.
I like steak. I like steak houses, but House of the House of Stake.
Well, Steakhouse is one of the vault curators on Morpho.
Steakhouse? House of Steak? I don't know. I prefer ribeyes.
Voting. Instead, it utilizes a vote escrowed mechanism to explicitly prevent governance capture by highly liquid tokens. Through years of rigorous iteration, NEAR successfully engineered a highly specialized distributed state machine. It is an architecture optimized entirely for chain abstraction and automated agentic flows, governed exclusively by the stakeholders securing its sharded state.
Huh. Great. Very interesting.
So Keith is saying that Burrow and Ref are now Rhea Finance. And then he says House of Stake is governance only.
Got it. So if we take a look, I've got a slide deck here for NEAR, but I also want to take a look at NEAR over on DeFi Llama just real quick. I want to see, what protocols exist here. So you've got Rhea Finance, and whenever it says one chain, that means it's native to, that particular chain. So we're taking a look here at NEAR, the NEAR chain. So Rhea is native to NEAR. And over the last month, look at these inflows. My goodness. Massive inflows. Here's NEAR intents. This is that cross-chain bridge that we were talking about. So this has just been taken off. NEAR intents. Let's check.
This is probably a lot to do with those changes in the tokenomics.
I mean, this looks great.
This is a testament to what we've been teaching here for months and months and months and months, that institutions, they're learning more and more about these protocols and about these chains. And I think people are waking up to the poor tokenomics of a lot of these assets, and they're starting to move to the ones long term that, and of course, the underlying tech and, the chains, the protocols, things like that, the architecture, all very important. But the tokenomics long term, if they're going to hold these assets and curate these vaults, with these assets, they, they are institutions. They are bound by their legal obligation to to earn yield, for their clients. So they're going to start to move away from these low value, or no value tokens towards these ones that have better tokenomics and better mechanics.
Yeah, and you see here where it says virtual bank accounts move between traditional currencies and digital assets, deposit and withdraw instantly. And then they've got over here on near debit cards. Huh? That is pretty cool because my understanding is that these are like permissionless, where you can just swap your Ethereum for Bitcoin or whatever. So it says here, sign in or create an account. I've definitely got to try this. And so, you can use a Near wallet, an EVM chain wallet, on a wallet on Tron, a wallet on Ton, a wallet on Solana, or, for some reason, XLM Stellar. But yeah, this looks pretty darn cool. Let's see, I've got that slide deck. Let's run through this slide deck so we can learn a little bit more about Near protocol. Here we go. So 2026 paradigm shift, the abstraction engine. So it looks like Near has moved beyond an isolated execution environment. It has become a universal orchestration layer or a decentralized backend for routing multi-chain liquidity, and translating AI intents. It looks like this is for executing bridgeless transactions. Bridgeless, that's interesting. Transactions across the entire Web3 ecosystem. So this is a big deal. Think about how many problems we've had with bridges.
Exploits.
Right. Constant nonsense with the bridging. But if that gets solved, or if that has been solved through this abstraction engine, oh man, that's a big deal. So the orchestration blueprint, systemic strengths and structural bottlenecks.
Well, and really quick, full transparency, I don't own any Near. I did in the past and sold it. Do you hold any?
I bought some yesterday.
Okay. I know. I just want to be transparent with everybody out there. We're not necessarily just talking our books here. We're just trying to educate. So again, I don't own any Near. And if I do, it's some dust in some wallet somewhere. And David just bought some, so we're simply just trying to educate you, not trying to influence you. We're not influencers here. We're educators. What you do with this information is 100% up to you.
100%. And, for me, I just want to learn more about Near, because, when I was taking a look at Thorchain and, they use Near intents for a lot of those permissionless swaps on Thorchain. But it looks like, Near is being integrated for that permissionless swapping into a bunch of different protocols. So I definitely need to learn more about that. All right, so it says here, chain abstraction, the ghost key architecture, deterministic address derivation. So key maps to a single user, a Near account to deterministic paths. Okay, so for example, Ethereum 1 or Solana 2. All right. And then multi-chain gas relayers. So relayer nodes pay native target chain gas. Users reimburse them on Near in a single unified token. Okay. And then decentralized chain signatures. So you got an 8-node MPC network, listens to the signer contract. Okay, let's continue on. The intents marketplace, execution mechanics. So here's step one. A user or AI agent broadcasts an intent. Let's say your intent is to swap ETH for spot Bitcoin. You're going to swap your spot ETH on ETH mainnet for spot Bitcoin on Bitcoin mainnet. Step two, you've got off-chain solvers that monitor the pool and submit execution quotes. That's the auction. Step three, the user selects the optimal quote and commits via on-chain authorization. Step four, the The solver uses their own inventory and chain signatures to execute across destination chains. And then step 5, settlement occurs via the verifier smart contract on Near, and the payout is released to the solver. Wow. So this allows you, this is the intent marketplace. This allows you to swap, spot ETH for spot Bitcoin for spot Sol, et cetera, et cetera. This is pretty cool.
So,
okay.
So Keith is saying also readable wallet names. Ledger also uses intents. And then says, so USDC on ETH or Sol or on Tron is just USDC. The network is abstracted.
Got it. That's pretty cool because it's basically solving for that bridging problem. I mean, bridging is basically sending messages, but this is a permissionless cryptographic way of doing that. I really like this. So, and then you've got here this agentic web. So it's an AI autonomy meets blockchain finality. So this is going to enable, it looks like, agentic commerce. Very cool. Okay, the consumer ecosystem and value accrual. Okay, so the Sweat wallet. This is the retail onboarding engine with 2.5 million active users utilizing chain signatures. I definitely need to pick up a Sweat wallet and see if I can start using this thing. And then you've got that Near.com super app, a unified interface abstracting wallet identity and gas across 35 chains. Okay, so it looks like I can use this Near.com super app, but I don't think that I need the Sweat wallet in order to use the super app because, right here, it looks like, okay, I can use an EVM wallet and, wallets on these other chains too. Maybe I don't need to use, that Sweat wallet to be able to do that. But I'll probably pick up a Sweat wallet anyway, just to be able to. Okay, tokenomics 1. Here's the tokenomics part. This is the stuff that's super important to us. So this deflationary engine. So the programmatic inflation was recently reduced from 5% to 2.5% after there was some halving event. And then they turned on the fee switch. So cross-chain fees are routed into programmatic buybacks, netting over 1 million Near repurchased by mid-2026. So this links cross-chain volume to token scarcity. Great. This is, a buyback mechanism. This is one of the things that we need to see. And then here, what do you do with those buybacks? Well, they get 70% of it gets burned. So 70% of base transaction fees are programmatically burned. So you've got 2 mechanisms by which supply gets reduced. That's bullish. That's very bullish, especially as this intense architecture for algorithmic, or I guess you would call it cryptographic bridging, starts to get adopted. I mean, this is great stuff. This is really great. Security economics and validator subsidies. Okay, a validator support program and validator nodes. Oh, that's right. So there are very few validator nodes. Okay, got it. So let's just say that there are 500 validator nodes. That's actually very small in number. So that's a risk to be aware of for sure. Governance transition. Here we go. The House of Stake. So you've got, here's the pilot outcome. Let me just read this down here. So the 3-month pilot utilized a 280,000 Near budget, successfully locking 4.8 million Near. It says it was driven by genuine proposal engagement rather than short-term speculation. Okay, so going to have to read more about the House of Stake in our next deep dive on this thing. 2026 milestones in quantum resistance. So that Near.com app is live. That's awesome. It looks like NVIDIA Inception. They prioritized enterprise GPU access, accelerating confidential GPU marketplace. Okay. And institutional access. So it looks like there's an SEC review of Grayscale's spot ETF for Near, alongside active European staking exchange traded products. Cool. And here's the positioning matrix. So you've got Near protocol, and we're going to compare it to Solana, Base, and Sui. So this is the type of scaling architecture. The moat is chain abstraction. The UX strategy is account abstraction. The cross-chain strategy is native chain signatures versus Solana with those manual bridges. Ugh. And then, layer two's base, they call it the super chain, but really like the volume's on base. And then SUI, manual bridges again. Yuck. And then hardware overhead here, it says low or stateless. On Solana, it's extremely high. And on SUI, it's also extremely high. So just keep that in mind. And then the target market here, it looks like, is AI commerce. So agentic commerce. Huh. Wow. So this is a Near protocol, actually looks like fucking A, man. Like maybe like a great deal here. But it's also run. It's also run quite a bit. So if we take a look at the performance of this one, just over the last couple of days, this has been quite a run. We're talking about just in the last, looks like about the last week or so, plus 90%. So big move, starting to pair some of those gains on the session today. But in my opinion, Mike, I still like this one quite a bit, and especially now that we know a little bit more about those tokenomics. It's really good to learn about those Near tokenomics, and I'm mostly interested in the chain abstraction. So what I want to do here is I want to try using this thing. At some point, probably not right now. We've only got a couple minutes left, but I really do want to use this natively and actually use the Near super app itself. This looks pretty cool, saying one account, no borders, your financial life on chain. Trade, access yield, and go confidential from across 35 plus networks from a single Near account. This is really cool. And look at what they're advertising here. You've got Bitcoin, Ethereum, Near, Tether, and Circle all living in one account. Very cool. So it says here, privacy by design, not by workaround. Deposits, transfers, and swaps stay confidential, visible to you and whoever you choose.
This is going to be key for anything that's going to be a major player in finance. And, the new hybrid finance of DeFi and TradFi. It's why Canton is so attractive to a lot of these institutions. Is it's not public. That they can have these siloed private networks because, it's just, that's what they want. So I think that that's very bullish for Near.
Yeah, I have to agree.
Keith is saying you can use shielded Zcash on it.
That is very cool. That's one of those high performing privacy coins, as Zcash is. I think that you can also swap into Monero using the Near protocol. Another one of the privacy coins. Actually, Monero just had a really big privacy upgrade too. But the thing that I'm interested about here is the debit cards. It says spend your balance anywhere cards are accepted. That is pretty cool. I wonder if there's more information about that. Let's see, what is Near? How to create an account? Can my business integrate? Okay, that's pretty cool. What are private deals? So it says, want to trade BTC for Zcash with someone? Create a deal, share a link. If they accept, both sides get exactly what was agreed, guaranteed by smart contracts. I like that. And it looks like confidential activity is coming next. Access yield on idle assets, AI-assisted financial management, tokenized RWAs, virtual bank accounts, debit cards, and more. The super app among super apps. Wow, if they're able to pull this off, man, then yeah, as long as there's no exploit, then those those flows into the Near token, which end up burning the token, those flows could definitely accelerate. So this is starting to look quite interesting. Now, if we zoom out to a weekly, this is so far, this is a nice breakout, a nice bounce, but notice that 200-week moving average. That 200-week moving average comes in right there, $3, just above $3. And there's also some, a horizontal resistance up there. So yeah, it's over the next week or two, it's going to be make or break time for Near during this Bitcoin bear market. So yeah, Near performing really, really well. Tron breaking out today above some resistance. Hyperliquid, big move over the last week, breaking out above this little parallel channel to fresh all-time highs. And Near, really nice performance. And then tomorrow we're going to talk about Render. This is one of those AI coins. If this one can get up to its 200-week moving average, that would be a nice performance out of Render. And then I think the last one that we'll touch on might be Zcash. So Zcash just hanging on right here, but you get above those highs at 750, and this one could run a little bit. So there are interesting plays on the board out there, and got to continue to watch BTC. If BTC gets up above its weekly highs from last week at 78,200, which is only about 800 points away, then you might actually see BTC run back up towards its 200-day moving average, which comes in right around like 81 and a half or so. So yeah, interesting stuff going on here, Mike.
Oh, absolutely. No, great information. So these deep dives that David does at the end of every show. So the first half of the show, the first hour is just news and going over charts. The second half is when we do these deep dives. That's why we do a 2-hour show. That's our format every time. These deep dives, we're going to be building out a library on our website. So if you haven't checked it out yet, let's show that real quick. Come over here to the node.pro, and this is where we're going to be building that out. And so like these video presentations, the slide decks, all of the information that we build out is going to be deposited there. So, in the chat, people were asking if we've done one on SWE. They've asked if we've done these on other projects. That is where we're just going to deposit them all. And as of right now, we're not going to be charging for that. So, that could change in the future, but, for now, we're just planning on launching it and allowing all of you to, take a look at it and, do deep dives on, on your own on, whatever project that you might be interested in. So, all right. Well, seeing a lot of new names. We got, Keith, we got One Arm Bandit, some other people in the chat. So welcome and hope to see you again. David, got any closing thoughts?
Yeah, join us in the Discord. Join us in the school. We've got a really vibrant community going on. So if you want to chit chat crypto or, Sovereign Soil or Saturday Night Fever or Gaming and Chill, those are all of our other shows. Jump into the Discord, jump into the school. A lot of stuff going on there.
Absolutely. Absolutely. So I hope you all have a great rest of your Memorial Day weekend. And please put some thought into what the weekend is actually about. I know that people like to go out and drink and have fun, and there's nothing wrong with that. Myself and others that have served, that's why we did it. Is so people have as safe and free of a country as possible to enjoy life like that. So, but please take a second, put some thought into the people that maybe went overseas and fought for something they believed in and maybe did not come home. So with that, thank you all, and until next time, Veteran Crypto out.
Peace.